In this section, I will be talking about first quarter's performance, including broad markets, asset classes we're investing, and our portfolios. So as we all know, a lot of things happened during the first quarter. So I want to start by giving you some context and laying out some big themes. It was definitely a quarter of reversals. The banking crisis raised a lot of uncertainty regarding the economic outlook and the future path for the Federal Reserve rate hikes. So here in the chart, I'm showing how market expectations for what Fed is going to do at its upcoming May meeting have changed during the quarter. So the expectations for Fed policy rate reached a high of about 5.3% on March 8th, after stronger than expected job and inflation reports. And then we had the collapse of Silicon Valley Bank on the same day, and you can see expectations changed overnight. Implied rates went down meaningfully and were close to 5% at the end of the quarter, meaning markets were expecting roughly a 50% chance of no rate hike and a 50% chance of a 0.25% rate hike at May meeting. So what does it mean? Well, as Chair Powell commented, right, the impact of the banking crisis, the impact of tightening credit conditions is equivalent to rate hikes. So while the banking crisis was severe, it has directly slowed down the economy and appears to have reduced the need for more rate hikes. So while there's still a lot of uncertainty regarding the future rate hikes and how much lending conditions are going to tighten on the back of this, markets are focusing now when the Fed will start cutting rates. So overall, that's not bad news for stocks and bonds. And judging from the final numbers for this quarter's performance, markets handled the banking crisis well. S&P 500 ended the quarter with a 7% gain. Investment-grade corporate bonds also were up 4%. So really the damage was largely limited to regional bank stocks. The sector lost 25% during the quarter. So nearly all asset classes performed well despite such an eventful and volatile quarter. On the fixed income side, all fixed income ETFs we invest in had positive returns for the quarter. Here I'm showing the quarter performance and 1-year performance. US Ag went up 3%, and due to a decline across the yield curve, long duration bonds were the largest contributors to performance this quarter, especially US long-term Treasury bonds, up more than 7%. Corporate bonds, as previously mentioned, held up surprisingly well given the banking crisis, broadly up 4%, as you can see here. International Treasuries and emerging markets bonds benefited from a weaker dollar. On the equity side, similar story. Equities also had a good quarter despite the event. Equity gained more than 7%, but there was high return dispersion among equities. Growth dramatically outperformed value, large cap outperformed small cap. So we have large cap growth as the best performing asset for this quarter, up more than 14%, a major reversal from last year, as we recall. And like value stocks, US high dividends this quarter lagged the broad markets, down close to 2%. International markets performed on par with US, up more than 7% as a whole, but again, with some dispersion. Europe performed the best, up 10%, better than Asia Pacific and better than emerging markets. And lastly, looking at alternative allocations, REITs, both US REITs and international REITs, they suffer from the concerns of credit tightening and they detracted from portfolio performance this quarter. Gold, on the other hand, was up 8% during the turmoil, providing additional stability to our portfolios. And that leads to our portfolio performance. Here I'm showing portfolio net of fee performance for global core, tax-sensitive, and not-yet income portfolios of different time periods. You can access our performance data through the performance sheets currently shared in the chat box and also on our New Frontier website. So for this quarter, all new frontier portfolios delivered positive returns in line with broad markets. Global core and tech-sensitive portfolios with total return objective have their returns range from 3 to about 6%, depending on their risk level. And due to the underperformance of high dividend stocks, multi-asset income portfolios returned about 2% this quarter. The yields provided currently are up to 5% as measured by 30-day SEC yields. So overall, the quarter was a good start despite a bumpy path. And Robert will talk more about what we have done during the quarter to our portfolios in response to those increasing uncertainty and risk, and also share market insights and economic outlook for the coming quarter. And before I pass over to Robert, I believe we will have the second poll here. And I think the second poll is about your biggest concerns. Rate sensitive clients, mortgage and rent increases, or cost of living sensitive clients for fixed income retirees, or shifting market regimes with lower growth, or managing client expectations or convictions, or in the end, extended market volatility or uncertainty. Let's take 5 or 10 seconds to answer the question. Okay, so extended market volatility and uncertainty is the biggest concern, followed by managing client expectations or convictions. No one seems to be concerned about rate sensitivity. Great. With that, Robert, all yours.
Thanks, Joy. All right, so we've been busy. I want to start by telling you about the asset allocation changes and some of our recent rebalances. And so when I say we've been busy, historically, people ask us this question, how often do you rebalance the portfolio? And most of you know, well, we can't answer that question directly because sometimes a lot of things change. There's big reasons to rebalance the portfolio. You need to carefully monitor the risk of all the individual asset classes. And then sometimes markets kind of move along in a more or less the way you might expect. And so as you can guess, recently it has not been the latter. So we have been doing a fair amount of rebalancing over the last 12 months. So most recently, this quarter, we rebalanced the multi-asset income portfolios on March 2nd. Previously, these portfolios had been rebalanced in November, so this is relatively recent. There is a few big changes here. These portfolios are very sensitive to changing yield environment, changing rates, and the shape of the yield curve, of course. So we introduced a new asset class, Treasury floating rate notes, which were able to take advantage of the high short-term rates and the, of course, less risk associated with them. But we're also monitoring the asset classes in terms of how sustainable and reliable is the income that they're generating. And international REITs had been on something that we thought was beneficial to the portfolio, but for some of the reasons that Joy has stated, they have become less reliable and they were removed from the multi-asset income portfolio. They're still in our total return portfolios, however. There also were shifts towards more reliable US dividends and generally more reliable shorter duration fixed income. And overall, the yields of these portfolios are roughly around 5%. Keep in mind that's a forward-looking yield. If you look at a portfolio right now, especially for something like, to take an extreme example, short treasuries, treasury bills, floating rate notes, you'll see that the yield that they got over most of the last year was almost nothing, but recently has risen a lot. So I think it's important to pay attention to forward-looking yield, something like an SEC 30-day yield, rather than the trailing 12-month dividends coming from them. Because of course, you care about the returns and the yields that you're getting in the future, not in the past. We also traded our global and US core portfolios more recently at the end of the month, last month, and these also introduced floating rate notes. There are many shifts that happened, and I'll tell you in more detail through an example later on. But broadly speaking, it reduced the duration of the portfolio and changed not just the fixed income, but the equity exposures as well. So just to say more broadly about how these rebalances have gone, thinking about the major theme of what's happened is there has been a lot going on with the Fed, which of course affects fixed income in a direct way and equities in a more indirect way. It's much more accurate to be able to capture what's going on with fixed income in terms of risk and expected return there. And so when these changes impact our investment process, it's no coincidence that the multi-asset income portfolios, which are most yield sensitive, with the rebalance test triggered them first and said that this is indeed statistically meaningful and improvement to likely investor outcomes for the investment objective of multi-asset income portfolios. For core standard portfolios, it's no surprise that they happened a little bit later. And for the tax-sensitive portfolios, they haven't happened yet. And these particular events of the Fed's reaction to banking crisis and the like may or may not ever directly impact and cause a rebalance for the tax-sensitive portfolios. Because there's obviously some difference in terms of the municipal bond market. Tax-sensitive isn't only municipal bonds, but there's some differences there in terms of the ETFs they invest in. And of course, there's a much higher threshold of what type of change is significant for a taxable investor, because we work very hard to avoid capital gains that are unnecessary and not beneficial to our investor. So a big theme that happened, though, is that we really normalized the fixed income risks in the portfolio. Thinking about last year, duration was really the risk and the only risk you should be thinking about primarily in your portfolio. And the other risks, especially on the fixed income side, like credit risk, were somewhat overshadowed by that. Now, there's a little bit more concern about recession going forward. Fixed income volatility is still high, but not nearly so high. There's a very inverted yield curve where you can take advantage of that with some shorter duration treasuries. And so a number of things have changed there. And it's important to have the right spread of risks across your portfolio. So that's it for rebalancing. And now I think I want to talk about what's going on in markets. And we are still in an environment where we have to interpret economic news and pretty much all news in terms of how is it going to affect the Fed, what's inflation look like, and what's that going to do to fixed income and equity markets as well. So one thing that's, I think, useful to think about here is you might have heard and noticed that there was a great deal of volatility in fixed income markets. The yields, short-term yields, short-term rates were changing a lot. And so here in this graph, I just plotted out the relationship between long-term volatility on daily basis of what rates might change like for the different parts of the Treasury yield curve, the 1 year, 2 year, all the way up to the 30-year Treasury rate, yield rates, and what's looked like for short term. And what you see is that for the longer term rates on the right, the gray bar, which is the last quarter's daily volatility, is fairly similar, a little bit higher, but fairly similar to the 10-year average daily volatility. But as you get very close, you normally expect short yields to be less volatile, but they've been much more volatile. And that's because the Fed really controls the short end of the curve, as we know. The reason there is because investors can directly speculate and say, well, if they know that what rates will be in the next year, then that will affect how they can build a portfolio right now and the performance of a fixed income portfolio there. So the Fed is really impacting the short end of the yield curve, and things like banking crises are going to cause a lot of volatility there. So just to show you what the yield curve looks like, what happened over the quarter is that we saw the red line is end of the quarter, the blue line is the end of the previous quarter. And so we do see that the short end goes up a lot. We see actually, though, that that the further end of the curve is actually lower, and that they cross over in the sort of intermediate range. So this kind of leads to a major thing going on right now, is that the Fed and the market are not in agreement. And so what I have done is I have superimposed the dot plot from the Fed. And just to let you know, we did our own dot plot through a poll just now when we asked what is the interest rate that you expect to see at the end of the year. And it was interesting to me that many of you seem to sort of agree with the Fed. So each of these little red dots is the vote with a sticker that one of the Fed governors or members of the FOMC got to put on the chart and say where they think interest rates will be at the end of this year, the end of next year, the end of the year after that. And then they have this somewhat ambiguous longer term view as well. But the Fed seems pretty focused on something a little over a 5% rate at the end of the year. Now, the market thinks that we're going to have a rate just like what the Fed is saying here in the middle fat part at the end of next month when the Fed meets. And you can see that the market is then expecting, though, that by the end of the year, it's likely that interest rates will fall. And the market is predicting about a 4.25 at the end of next year, falling much more the year after that. And the Fed also expects rates will fall, but not nearly as much as the market. And then it's interesting that they cross over at the end of 2025. And I put this oval over here to say, because there's sort of a range of what exactly longer term means in terms of a market prediction, but the market is predicting much higher longer term rates than the Fed is. And so these disconnects are going to play out in the terms of volatility, right? If the Fed is right, then markets will have to adjust. If the Fed is wrong, then we're going to see that there are some changes that will have to happen to Fed policy to get there. And that probably means that the market is going to be slower than they expected. A really important thing that I want to bring up on yield curves and plots like this is whenever you have a market price of any kind, really, but especially when it's a market price of something slightly more abstract, like a market price of bond return in the distant future, then that is a reflection of an equilibrium for all the different market participants that are pricing that bond. And that can be because they think they're going to, that's what it's really going to be, or they have just actually a preference for hedging risk at some point in the future. And so, but also importantly, there's many different opinions there. So whenever you see a yield curve or anything even like what I'm showing you, you might be tempted to say, oh, well, that means that the market's saying the Fed's wrong and that there's going to be a recession and this is exactly what it looks like. No, that means that somewhere in these range of scenarios, perhaps is a story along those lines. But there's a lot of different opinions out there, and the yield curve does not represent one particular story or scenario. So I don't want to beat up on SVB or anything like that, but just very quickly, there's a cute thing that I like, that there's a unfortunately named bank called Republic First. And when bad news comes out about First Republic, sometimes Republic First goes down as well. This is kind of going along with my dad's theme of you have to think a little bit along the lines of psychology and social science and think about, well, what happens when humans are introduced to the investment world. The other thing I want to point out is how flat the market overall return has been throughout all of this. For the blue line is the S&P. And to me, what has really happened here is that the market has totally said, this banking crisis was just like doing our job for us. It was like a rate hike. And the market itself, that's what the Fed thinks. And the market very much agrees. And shockingly, it thinks it's really a fungible event, that rate hikes and other things like banks failing are interchangeable. And so then it's really just absorbing these events, and they're almost like it didn't happen. And to some extent, I'm a little surprised here. I thought that the Fed can slow down the economy by relatively gracefully pressing on the brakes, and a banking crisis is more slowing down the economy by running over a very unpleasant thing but actually it looks like the Fed's brakes are pretty unpleasant too, so that they equal each other out. So one thing to keep in mind, right, rates are very high. How does it affect banks? There have been deposits leaving. These are not things that I worry about in terms of creditors depositors losing their money. But if you've noticed that interest rates are very, very low from many of the most stable banks, and there's a disequilibrium there, and sort of as an economist or a finance person, then you think that, well, a disequilibrium doesn't like to exist for long. It's not quite arbitrage, but almost, to think about just moving your money to another bank. And so there's more to play out here before this happens. And so the profitability of companies is going to change. And there's just always this effect that as lots of things change, that influences business uncertainty. It makes it harder to plan, that makes it harder to invest. And that tends to slow down the economy and not be particularly good for it. So for many of these things, there's Treasury floating rate notes, and we've talked about them, and I don't want to overhype this asset class. It's a neat asset class. It was a relatively new asset class. The Treasury first introduced floating rate notes in 2014. Sometimes people also talk about floating rate debt from corporate bonds. This is different in that the yield is a little bit lower, but there's zero credit risk. So it's nice to have an asset that is almost no risk of any kind. Just to tell you what they are they're actually 2-year notes, but their price is reset, their yield is reset every week with the latest Treasury auction. So they have a duration of roughly a week, which is roughly nothing. And interestingly, they are priced by the Treasury currently at a premium of 20 basis points over that, which makes them a slightly better deal than just buying the Treasury notes and rolling those over. And some people have also asked, well, why now? And the answer is, well, a year ago, these had zero return and weren't particularly interesting. So it's been an asset class we've been looking at for a long time. And it really helps the optimization. It's also an asset class that's easy to get out of if things change as well, which is one thing that we're always thinking about when we're building portfolios, which is, and these are sort of unique in that they're highly liquid because they're based on treasuries. They're also, the price hardly ever moves, so there's not going to be any tax consequence from them either. So I wanted to show just a little bit, and we're unfortunately kind of short on time, so I'll do this quickly, but I wanted to show a little bit like what happens to an optimal portfolio when things change. That's always an interesting question. And so on the right, we have our previous optimal portfolio from November. And on the left, we have this new portfolio that's taking advantage of a different shape of the yield curve, a more normalization of credit risks. As I said, you don't have to be quite as scared about duration as you were before, but now there's also more desirability for short duration. So these things are kind of working in opposite directions in some sense of duration's not quite as risky, but it has a lot less return. And there is a very low risk asset that has one of the higher yields and perhaps rates of return, at least for right now. And so you end up with very different looking portfolios. And I can't go into the details too much, but another way to save on lots of time is to summarize everything that's going on in the world in a table. And so I want to note that these are talking about risks of recession and inflation. And so positives are bad things, just like news from the test from a doctor. So how do the different things going on in the world affect the two major forces that the economy is worried about? Recession risk, which is going to make, very broadly oversimplifying, going to make your stocks do poorly, and inflation, which is going to hurt your bonds. So bank failures are actually kind of okay for bonds. They do the Fed's job for them, much like a Fed rate hike, but they increase the likelihood of recession. China has been opening up, which has been kind of interesting. And so there's that in some sense, is making the global economy work a little better, lowering the risk of recession, but it has a mixed effect on inflation because there will be higher prices perhaps for inputs, other commodities, but lower prices for manufactured goods, which helps. Europe's done fairly well, all things considered. It seems like it's made it through the winter, and not everyone was sure of that. And we see it in European stock returns, of course, but it's a good thing for the world and for the economy, of course, that this has happened. And but similar to China, it's good for the global economy, a little mixed for inflation. Geopolitical risks are a few big ones there that are on all of our minds, but they're unpredictable by nature, and it's makes it difficult to plan for, other than stay diversified, be very careful about risk management, make sure that your clients are in a portfolio that they're comfortable with if something goes wrong. Another thing I like is what I call long economic COVID. So long economic COVID is that unfortunate feeling you get every time you're dealing with another business and things are just not going the way they should. And this is unfortunately not something that we talk about, but it is something that is not good and is making inflation a little stickier and making it slower for the economy to bounce back. If we want to be really positive, though, another thing in the news is artificial intelligence, where productivity gains, technology gains, these are really the things that move society forward, benefit everyone. And so if we want to be slightly optimistic about the future, this is a reason to be so. And things like the oil production cut, not a huge impact, but and I would say this is probably the least important thing on the list, but it's clearly a bad thing. It's a smaller version of why we were so concerned about Russia invading and isolating itself. So taxes, the last major thing I want to talk about, tax day is tomorrow, something like that. And there are, we have, I guess, some good news there, which is in all of the ETFs we invest in, ETFs are on average fairly tax efficient, but we put a lot of effort into making sure that the ETFs we are investing in, especially in our tax sensitive portfolios, of course, are not likely to have gains, and they didn't. We also have this tax tool that allows us to carefully analyze what the actual realized outcomes are for investors over different time periods. And so we can test over many time periods over the history of our portfolios, different cash flows, and see what investor outcomes were like. And we've been very pleased to see that there were no short-term gains in almost any instance. And in particular, most investors over the last year, we expect to see some short-term losses. We deliberately sold things that went down in the 1 to 3% range. But I want to remind people that there are long-term gains, there will be long-term gains. The whole point of investing is for your portfolio to go up. And the whole point of having it professionally managed is that we're looking at it every day and making sure that it has the right risk exposure. So we're not deliberately taking any long-term gains for sure, but our job is to make sure that your clients are in the right portfolio. And so that does require, especially for some of the things that have gone up and maybe are overweighted in the portfolio and outsized risks, for us to take advantage of that and rebalance the portortfolio. And then final note is that 2022 was an unusual year for tax loss harvesting. If any of your old mutual fund clients are still invested, it's probably not too late to switch them over for a relatively low tax effects. But if you were thinking about tax loss harvesting as the main reason to invest, please don't. It's not likely to repeat, and it's probably the wrong reason to be investing. So just very briefly, what are some of the key things? So the Silicon Valley Bank and the banking crisis in general isn't the end of the world. It's been surprisingly resilient. Your deposits are probably safe, and it was the Fed's plan anyway to slow down the economy. Bond risk is relatively high, but think about it in a more normal sense, and it's definitely less than it was last year. Stock and bonds are, as generally is the case, are priced by the market so that future expectations should be positive. Bad news can always happen, but future, some amount of bad news is priced in, and at this point, certain recessionary risks are already priced in. So if things play out in a not much worse way than expected, then portfolios are generally okay. But a time of diversification seems like it is here. Joy showed just how different certain asset classes like large cap value and large cap growth, and how certain different international markets played out over just this last quarter. And this sort of reminds us of the importance of diversification. So I really appreciate you guys staying with us, and now we can answer the questions, and at the end of the questions, we can have a survey. Thanks.
Great. Thank you, Robert. And thank you to everyone who submitted questions. We have received a lot of great ones. So with that, let's get started. The first question is about rebalancing. Have there been any changes to your rebalancing process this year? David, do you want to take that?
I can take that question. So as you probably know, we have a statistically based rebalance test that measures how plausibly optimal the portfolio is compared to the new optimal portfolio. This test has basically been fairly mature for many years now and hasn't had a lot of innovations to it, but it's highly adaptable and will behave very differently under different market environments. So the last year has had a changing interest rate environment. And so we've seen a lot of activity in rebalancing for our various strategies during this last year. But the basic underlying machinery of the test is the same as it's been for a long time now.
Great, thanks, David. We also got 2 live questions coming regarding the model allocations on the fixed income side. So Robert, when you mentioned those. So the first one is, with the likelihood of decreasing rates in the future, are we focused too much on the short-term rates and not locking the better rates on longer duration? Are we taking short-term gain and giving up better long-term results when those mature?
Yeah, that's a very fair question. And so what we're always, from a pure, just thinking about a savings account and investing in a CD, one asset at a time, how much money will this risk-free bank account turn into? Then that's a very fair question. And it should be priced relatively fairly is the expectation. And so the reason why you're right, short-term rates are so good and long-term rates are not is that the market expects these things to rates to go down over time, and that there should be some sort of parity. And historically, there has been a equivalent, actually a premium for holding longer duration things. So that's definitely thinking along the right lines. But what we are doing is we're thinking in terms of a whole portfolio. And we're thinking about, if we can reduce risk in one place, where can we be a little bit more aggressive here? And the long-term duration bets tend to pay off about what the yield is. In fact, with a treasury, if you hold a treasury to maturity, it will pay off exactly what that is. So comparing that to some of the opportunities with a little bit of credit risk, it's not as valuable right now. And this also, just generally reducing the risk of your portfolio, is a good thing that lets you invest in more other types of return premium.
And regarding another return premium, credit, the other question is about what's the reasoning behind moving out of IG bonds and into high yield bonds if the likelihood of recession in the near future is high? That's also related with the model changes you mentioned.
Yeah, so we're keeping it brief. We are definitely worried about default risk in high yield bonds. We model that carefully, and we adjust forward-looking expectations for the relatively high risks right now of that. They're not astronomical by our guesses, but they are relatively high. But again, this is all plays into what's going on in the portfolio, and there's a little bit of an extra premium there that if you're taking less risk in one place, you can invest in.
Thanks, Robert. And I want to acknowledge that we got 3 questions about asking about fixed income allocation, how to optimize based on the current yield curve. And I believe Robert has mentioned about them in length during the program. So I want to switch to another topic, recession. We got 3 questions about recession. Do you foresee a recession occurring, mild or more severe? Timing of that preparation you are taking now, and or how deep do you estimate the recession, if any at all, this year, coming in next year?
Dick, do you want to answer that one, or I can if you don't want to?
I think you should try.
All right. Well, so one thing is the Fed just yesterday said that for the first time they're admitting that there's a real risk of recession. And the markets have been predicting this for a while. And that is a big reason why the long part of the yield curve looks the way it does. Is there are 2 reasons why people might invest that way, is they expect that they'll be making more money that way, or they might be trying to hedge a risk a little bit further out into the future. And so that's what probably is driving things there. So I think that's the short answer to the question, is the risk is real. Although this is a highly anticipated recession, people have been talking about recession for a year and a half, and much of this is priced in. And so what we've been saying for a while is if there's only a mild recession, then markets might actually go up. At least that was, how I felt 6 months ago.
Mm-hmm. So the other question is about geopolitical risk. So how does geopolitical risk, especially China and the US, factor into portfolio management?
Yeah, so that's a hard risk to manage as a portfolio because they can be so big in so many ways. And there are these literally nuclear types of, or cataclysmic things like a World War III or the Treasury defaulting. But maybe you can tell us a little bit. You just came back from China, how they feel about it.
Yeah, I think for sure, no one can tell and really predict the timing or scale of any of those outbreaks. It's highly uncertain and unpredictable by nature. So really for us, we monitor those geopolitical events and factor them into our process, sometimes in the form of risk penalty, like on assets affected, on top of historical risk, to account for higher than expected risk and uncertainty, so that the portfolios are well managed, and especially less risk tolerant portfolio 2080. We make sure that they have less exposure to EM ETFs. And so given the limited of time, here comes our last question about alternatives. What types of securities do you use to get exposures to alternatives like commodities, managed futures, infrastructure, etc.? And how do you manage allocations to alternatives in our portfolios?
Yes, so just with the asterisk that for multi-asset income portfolios, there are some more interesting income generating asset classes that are considered alternatives that we use there. But the main alternatives that we think about in our core portfolios are things like REITs and also things like gold. And the reason why we say like a gold ETF is not because it has done so well recently, but because it is a highly liquid, highly understandable asset class that has pretty well-defined relationships between the other major asset classes. And so that lets us really manage risk well. We think of these things much more in terms of being able to better manage risk, better diversify the portfolio, and we certainly don't think of them in terms of a speculative bet.
Okay, great. I think that's all for today. And of course, for questions we didn't get to today, we will follow up with each of you to make sure that your questions are answered. And again, thank you for attending. Please reach out to our consultants at any time if you have any questions. And before we conclude, please take time to take the survey at the end of the webinar. Your feedback is highly valued. Thank you again. Looking forward to seeing you next time. Have a great day.
Thank you.
Thank you.